What's up, guys? It's Cash Flow Cart, and we have a very exciting video today. We are talking about the road to 100,000. Guys, I've completed this challenge. I officially have $100,000 in dividend stocks. We're going to be talking about what that looks like, how much it pays me, but what I'm most excited about for this video is talking about two key concepts that I've learned on this journey to 100,000 in dividend stocks. These concepts are going to help me, exceed and continue to grow my portfolio at an even faster and more efficient rate than I was prior. Guys, as you can see, we have $99,707. We broke, so that is under 100K, but February 25th, 101,407. We went to 102. All-time high is 102,393. Hopefully we can smash that soon. Of course, we have to dip back under 100K the day I'm recording, but that's okay. I'm not beating myself up over it. How do I feel, guys? I'm excited, I guess. I've achieved this short-term goal of breaking 100,000 in dividend stocks, but I'm also not that excited because I want to take this further. I know I can do more. I want to take this to $250,000. I want to take this to $500,000. And then I want to take this to, $1 million dividend portfolio that can provide, life-changing income, right? That's where my head's at right now. We're going to talk about, two concepts. Again, these two concepts aren't the end-all, be-all. It's just what I want to talk about today, guys. So without further ado, let's get into the video. We will visit the portfolio performance right now, just so you guys can see, what I've contributed versus my, it's not like I put $100,000 cash in a portfolio. I want to show you guys I actually have legit great performance. If you've been with me, I'm sure you already know this. So between the date May 14th, 2024, that's when I, switched over to this Schwab account, to March 15th, which was, yesterday. My beginning value at that time was just under 56 grand. I contributed just under 21 grand, and my investment change was $23,333 in profit. That takes me to the $99,745, guys. What does that rate of return look like? Again, this rate of return does not include money I've invested. This is truly just, my investments return. So on the same time period, because again, that's all Schwab has data for, I've annualized 18.45%. I am proud of that. It's almost 2 years. If I can annualize over 18%, every year in perpetuity, that's going to add up and that's going to compound into a lot of money. I have outperformed the S&P 500. In that same time period, the S&P 500 has returned 15.4%. I'm right in line with the NASDAQ at 18.5%. Guys, again, this is me managing my own money. I'm not paying any fees. I'm not paying for anyone to help me with these investments. This is my stock picking and my trading, and it's annualized 18.45%, guys. Okay. Let's get into the two concepts that have helped me get here in my portfolio. Starting out with the first concept I want to touch on. This is something that is so hard for dividend growth investors to get through their head. It's something that took me years, and it's something I still struggle with, and I still have temptations. But the biggest thing that's going to stifle your returns, it's going to hold you back, and it's going to bring you closer and closer to average or even below average, is going to be over diversification. I pulled up an article here, portfolio over diversification. Are you hurting your returns? I would argue that yes, you are hurting your returns with portfolio over diversification. We're going to talk about what that means, and we're going to talk about the correct way to think about diversification, the way I am going to be thinking about diversification as I take my portfolio from 6 figures to, towards 7 figures in the future. So let's just read through this, guys. Okay. Diversification, as we all know, it lowers volatility in your portfolio. Okay, you have one stock and you buy another stock unrelated. Well, that's going to lower your volatility. Very, very common sense stuff here, guys. Investors spread across sectors, industries, countries. Unsystematic risk is company specific and can be reduced. Let's talk about that. Unsystematic risk. What is unsystematic risk? That's not anything on the macro level. That's stock specific or sector specific concerns. Okay? You're holding 3M and a bunch of veterans, file a class action lawsuit because they've lost hearing. That's company specific risk, all right? That's unsystematic. Systematic risk is, okay, there's wild inflation. People are changing their spending habits. We fall into a recession. That's the system. That's what systematic risk is. Unsystematic, again, think at the company level. Systematic, think at a macro level. Unsystematic can be reduced. Systematic risk is market-wide and cannot be reduced. So at some point, as you're adding stocks, seeking more diversification, it's a law of diminishing returns. And what do I mean by that? After you have a basket of stocks that you feel good about, it doesn't further diversify you. It doesn't de-risk you by adding one more stock at that point. Okay? Because now the only risk left in your portfolio is systematic. Got it? I guess I just kind of gave away the next bullet point. Beyond a point, extra holdings add little risk reduction. Okay. We all understand that. There's a chart here to help further explain. It says number of stocks. You got one stock, high volatility. Yeah, it doesn't really even make too much sense because what if it's a low volatility one stock? Whatever. So there's a lot of risk with one stock. There's a significant risk reduction with 10 stocks. Guys, I only hold 8. At 20 stocks, very close to achieving optimal diversity. I want to talk about this. I think this 20 stock number right here, I think that's great. I agree. You are very close to achieving optimal diversity at 20 stocks. But what I want to say to follow that point is you should not be getting to this 20 stock mark until, you're a higher net worth individual, A, or B, you're closer to retirement age and you actually need, that optimal diversity. If you're like me and you're in your 20s, you're in your 30s, you're in your 40s, you still have a full-time career, you don't need to be at the point where you're fully diversified. That's not the case. Instead, aim to get to this 20 stock number over the years, throughout market cycles. Okay, so when one sector's down 5 years down the line, now, okay, I'm a bargain shopper. I'm finding which stock I want to start adding to in that sector. Okay, and again, I said I have 8 stocks now. By the time I get to this portfolio to $1 million, I want to be closer to that 20 stock mark. But it takes time, guys. And I think a lot of people jump into this game and they see, well, this guy's a great investor. He's got a high net worth. I'm not talking about me. I'm not trying to be cocky or anything. But they might look at someone with a high net worth. Like if I'm looking at someone with $1 million and plus and say, oh, wow, he's got a lot of stocks. He knows what he's doing. I need to diversify like that, right? No, wrong. We need to be focused on, adding 1 or 2 stocks so we can have, longevity in our career and we can get the best opportunities at the best times. Does that make sense? 50 plus, minimal extra risk reduction. If you're ever planning on getting to 50 plus or this is ridiculous. Even 20 to me sounds like a lot. For a true stock picker, 20 feels crazy. But I get it. Once I get to bigger numbers, I'm going to want more diversification. If you're thinking about 50 plus stocks, you should not even be in the stock picking game. You should be buying mutual funds and ETFs. And that's just the way it is, guys. All right, I'm getting on a bit of a tangent. It says here, 100 plus, no further benefit from diversification. Yeah, I get that. But a lot of people don't, okay? They just say, I'm buying dividend stocks. My dividend income's going up. So it's good. I have diversification. Right? Wrong. There's 2 other things I want to touch on before we move on to my next point. Here, right here, reduces company-specific risk. I know I keep harping on that, but on the flip side, if you're reducing company-specific risk, you're also reducing company-specific reward, okay? And I'll pull up one of my own great examples. You guys have been seeing me build Pfizer for a while. I'm going to take this to 1,000 shares here in the next few weeks. Altria, guys, I talk about all the time. Be an opportunistic investor. Find where the best bargains are. I love pulling up Altria because it's a great example of me focusing all my free capital on one stock, right? So yeah, I had company-specific risk in Altria, but if I would have been spreading out my capital, I never would have seen hang on, sorry. Mouse is being weird. I never would have seen, this 56% upside that I've achieved in Altria on, almost $20,000 of capital. I would have just seen that return on a much smaller chunk of my capital, right? So yeah, you might be reducing, company-specific risk by adding more and more stocks. You're also reducing company-specific reward, okay? You got to see the flip side of everything because, I think this goes back to the fact that you could find an article or you could find an advisor in this finance space who will confirm any bias you may have in your head. Okay, so make sure you're always looking at the flip side of different points. Right here, one other thing I want to talk about. If you have more and more stocks in your portfolio, you are going to lower portfolio volatility, right? That makes sense. Because if you've got 100 stocks at 1% allocation each, if one of your stocks falls by, 50%, you're only down 50 basis points on your entire portfolio. It's not very volatile the more stocks you have. What I will say to that in return is, as a dividend growth investor, I have to remember why I'm doing this. Okay, guys? The reason I'm buying these stocks and the reason I'm investing the way I do, it's not to avoid volatility. I'm a stock market investor. I understand and I'm comfortable with volatility. Okay? I have no problem with being up or down 2, 3, 4, 5 grand any given week. That doesn't keep me up at night. Portfolio volatility is not okay, or it is okay, because what I care about is my portfolio income. Okay? My passive income stream that I'm generating from my portfolio that's stepping up year over year over year, right? If that trend changes of my income, then I have issues, right? But in terms of my portfolio volatility, again, that's not going to keep me up at night in the short term. And I will, with time, get closer and closer to that 20 mark, as the years goes on. And hopefully as my net worth kind of starts to curve upward. Guys, okay, I'm going to start wrapping this point up and then we'll get into our next point. Lastly, again, I just talked about it with Altria. The market's not going to give you that many great value opportunities at a time. Okay? If you have a lot of great value opportunities, comment them down below. I want to read through them. But again, just the nature of the market, different sectors are going to be overvalued, and even undervalued sectors, there's only going to kind of be a few high quality stocks in bargain basement territory, and that's what we're looking for, and that's how we get the diversification over time. Okay? The last thing I want to say to kind of cap off this first lesson is you will not ever learn and you will not ever grow as an investor if you're focused on so many different stocks, right? So it's better to focus on one stock and to fail and to learn a valuable, maybe costly lesson than it is to just diversify and throw money at stocks, but never be able to read the own lessons in front of your eyes because you have so many things on the chart. Guys, focus on one stock. If it works out, great. Build out the position. Enjoy that income stream. If it doesn't work out, and again, I've had many things not work out for me. That's 100% true. I can go through example after example. I've got them burned into my skull. If it doesn't work out, take the lesson. Don't sulk and move on. But if you're just so diversified, you're never, ever going to improve as an investor. Okay, so that's my number one rule for you guys moving forward is lifelong diversification. This is a long game, okay? Do not ever over diversify early, right? If you have $10,000 or less, you should not be looking at more than 2 stocks ever. You should never be looking at more than 2 stocks if you have, that smaller amount of money. Again, as you go, as you start to earn more money through your career, year after year, then that's when the diversification kind of kicks in, okay? But until then, don't rush it. Take your lessons, build your positions. Number 2, okay? The number 2 concept I want to talk about, over management as a dividend growth investor kills long-term returns, okay? I'm going to prove it to you. I'm going to mathematically prove it to you. But first, let's talk about the 3 points of why over management as a dividend growth investor kills your long-term returns. Number 1, it resets your yield on cost. I'm going to give you guys the formula, okay? If you're looking to get into this dividend growth game, this is a formula that, you're going to fall in love with. Yield on cost, okay? Here's the formula for it. And it doesn't just apply to dividend growth investing. I apply it to dividend growth investing in this example. So let's talk about it, right? Your annual dividend, right, divided by your original purchase price. Does this make sense? That's different than the dividend yield. Why? Because a dividend yield formula is annual dividend divided by the stock price, okay? The current stock price of what it's at. No. Yield on cost is what kind of creates this dividend snowball and effect. So if I was going to try to talk through an example verbally, but I'm realizing that might be way more complicated than just showing what it actually looks like in practice. We're going to stick with our Altria example, okay? Sorry, I got a little flustered there. Had to pause the video. Probably crop some stuff out. The formula we're working with, the formula that allows this game to outperform every single other type of investing over the long term, is this yield on cost formula. That's the annual dividend divided by the original purchase price, okay? Or instead of original purchase price, I'm going to use cost basis, okay? So I'm going to use my average price of all my tranches of Altria. Let's look at that. Guys, my average price on Altria is $44.56, okay? What's Altria's dividend right now? It's $1.06 quarterly. We're going to take that $1.06 quarterly. We're going to multiply it by 4. Altria is paying $4.24 annually, right? Now, remember our formula. We're taking that $4.24 divided by your original cost, the original purchase price. So I'm going to divide it by my cost basis, which is $44.57. Okay, we'll do times 100, so it's like more accurate, I guess. Whatever, who cares? So I have a yield on cost of Altria of 9.5%, right? Let's go back. So my yield on cost for Altria stock is 9.5%. What's the current dividend yield for Altria? 6.28%. So do you see how by using undervaluation and dividend growth, I've essentially created a 10% cash flowing asset that's produced capital gains and is going to continue to grow their dividend year after year. That's why this is so great. And, I'm getting a little off topic, but if I were to sell Altria, once I started to see, a little bit of a breakout, a little bit of a profit, once I got to, $1,000, $2,000, $3,000 in profit on it, I'd be resetting that yield on cost. And I would never get to that 10% yield on cost that I'm enjoying now. Okay? But guess what makes it even sweeter, guys? As this quarterly dividend for Altria continues to grow, year after year, like Altria has proven over time that it will, my yield on cost is going to go up and up and up. So at some point in the future, my yield on cost on Altria is going to be 15%, 20% plus for dollars invested. Okay, so it's like every $100 I've invested in Altria in the past, as time goes on, that's going to be paying me $20 in income. And it's been an appreciating asset. So this is why over management kills long-term returns. 1, it resets your yield on cost. 2, and we don't have to do a song and dance about this one because it's point blank. It can trigger a taxable event. For me, I trade in an individual account. I don't have any retirement account or whatever. I know that might be taboo for some of you online investing people. But no, I trade in an individual account. So if I sell and realize, $5,745, I'd be paying long-term capital gains on that. And that would just be money that I would have to set aside and not be able to put back into my dividend stocks. Less dollars to invest. That is, quite simple. And number 3, and last but not least, on why over management as a dividend growth investor kills long-term gains is because most of the time, guys, it's just simply not the correct decision. Okay, I know I've shown examples. I've done examples. I'll pull up a few and we'll talk about it. But this isn't like a math equation. This is a human psychology equation. Most of the time, if you have a high-quality stock facing turmoil and news, human psychology might tell you, oh, God, this stock's stressing me out. I need to cut it. I need to stop now. I need to cut my losses. Whatever. No. Incorrect. It's wrong. That's not what you should be doing 99% of the time. We'll look at 3M. Here's one I completely botched. Right? So, again, I mentioned earlier in this video, actually, when they had all their lawsuits with veterans and stuff, I panicked. Okay? I panicked and I sold. And really what I should have been doing was buying through this dip. But I sold and I panicked and it hurt my returns because I realized a pretty hefty loss. I mean, I could do the math, but I'm not going to. So I had 34 shares I took off for a pretty big loss. Okay, that hurt my returns, quite substantially. Another one we've talked about before, AbbVie. And on the flip side of it, AbbVie is one that I made money on. Hang on. Well, I had bought back here. I don't know why I don't see the green tag. But AbbVie is one I had made money on an uptrend. Right? Great. No. Wrong. I overmanaged. If I would have held AbbVie for all this time, I would experience years and years and years of dividend growth. Instead, I took my measly little 7 shares of profit. No one cares. I overmanaged and I hurt my returns. Okay? Does that make sense, guys? This video is kind of already getting to the length I want it to be at. So I think I'm going to hold off on, doing the full breakdown of like every individual stock. I said I want to take Pfizer to 1,000. I want to come back and I'll do a breakdown like in next video for sure. But in this one, I'm happy with the 2 concepts I've talked about, guys. Number 1, over diversification kills returns. Over diversifying your portfolio quite literally makes you more average and closer to, the herds and the masses. You don't want that. You want to outperform. Guys, it's a lifelong commitment. So don't over diversify right away. It'll come with time. Number 2, over management as a dividend investor. It kills your returns because it resets your yield on cost, triggers a taxable event, and most of the time it's you in your head panicking and having weak hands, and it hurts you a lot in the long term. Guys, short-term profits on AbbVie, short-term profits are never going to exceed the returns of long-term yield on cost and dividend growth investing. Okay, so, bottom line is, guys, thank you so much for being on this journey with me to 100K. It was super fun and rewarding. I'm excited, but I'm hungrier than ever. Honest to God, and I'm ready to keep moving forward. I'm ready to see, kind of what stock is next for me. Subscribe if you want to stay updated. Like I said, I'm going to buy this to 1,000. Then I'm going to try to sit down and do like some deep due diligence on which stock from my watch list I maybe want to add next, or which stock that I own I want to add to. We will see. Guys, thank you so much. This is Cashflow Cart. Everyone have an amazing day. Let's build wealth.